Happy Wednesday, everybody, and you're watching Talkenomics live at the end of April. We're about to start May 1st. Spring is here, and the markets are smiling somewhat. I mean, we started the day in negative territory after a disappointing GDP read. We saw contraction, although not negative. It was, 0.3% we grew, whereas in the fourth quarter of last year, we were growing at 2.4%. But they did recover, the markets, the indices, as we headed towards the closing bell. And then we had something very exciting happen. The Mag 7, which everybody has kind of been, brushing aside. We got the reports from Microsoft and Meta, the quarterly earnings report, and they beat and blew everyone away. Let's start with Microsoft. The shares jumped after hours, something like 9%. Their revenue came in at $70.07 billion, which was a beat, but it was Azure Cloud. $42.2 billion. It was up 20% year over year, and it's one of the reasons right now shares of Microsoft in the aftermarket are still trading higher, something like almost 8%. So congratulations to Microsoft and the team. We will see if they can keep that going as we go into the next quarter. Then we got the Meta report. Now, here's what's key about Meta. Shares are also up right now, but it was the guidance and CapEx that investors seem to like a lot. CapEx, they said, would be 64 to 72 billion, where analysts had been expecting it to be anywhere from 60 to 65 billion. The other factor is that they beat on revenue. It was quite solid. They came in at 42.5, or rather they came at 42 billion, but their guidance for the next quarter was 42.5 to 45.5 billion, and analysts were expecting it to be a top of 44 billion. So we're watching those shares trade higher right now in the aftermarket as Meta actually heads towards its next quarter. It appears to be on firm footing. So I slugged this episode of Talkenomics, Profit from Disruption, because for many of us, we have been able to just glide along. If you're an index investor, if you're a passive investor, enjoying the ride of the Mag 7. But really for the last 40 years, you could follow Warren Buffett's advice about just put it in an index, set it and forget it, as Ron Popeil used to say, and you would be good. But that's no longer the case. So the first guest I want to bring in is going to help us understand what is actually being disrupted and how we position our portfolios going forward. Dr. JoAnne Feeney is portfolio manager at Advisors Capital. It's a pleasure to have you here. And I just want to share with the audience a little bit of the background, because you've been on CNBC. They know you well there. You're on Bloomberg. You're on the other programs. But you hold a BA in economics. You have got your PhD at the University of Rochester in economics, and you have contributed to the IMF, you've contributed to the Federal Reserve, but you've also, I'm going to put this in layman's terms, you have been able to take the macroeconomic trends and then kind of figure out the dynamics of what's going on with industries as a way to then invest. And that's what I think a lot of those of us who are novices seek from someone like you, is the advice, what do we do next? So welcome to Talkenomics Live.
Good to be with you, Adam.
So let me start here first. And I just want to talk, when you talk about Microsoft and Meta, it was as if the Mag 7 had been dismissed. Is this quarter, can one quarter tell us that was a mistake to dismiss, or should we be looking at other factors in the next 2 or 3 quarters to say that they're still on top or not?
Well, the details of one quarter can be a bit reassuring. I think there was this concern that we might potentially see a pause in spending or in the development of AI-based applications, and that would feed through into Microsoft's cloud numbers. And clearly it didn't. Azure's strength continues. It came in ahead of expectations, and it looks like it's going to continue. And more importantly, they reaffirmed their CapEx spending. So they're continuing to see value in building out their AI architecture, and that can only be the case if they see the demand for it.
When we talk about demand and we talk about AI, there was also the Meta CapEx, which was higher than I think some analysts had been expecting, and Meta also making this play into AI, but so dependent on advertising. Help someone like me, help us understand, how do you to figure out what Meta is actually trying to accomplish, especially when they're going to be up against powerhouses like Microsoft when it comes to AI?
Yeah, it's a little bit tricky. We don't own Meta for clients. It's sort of a complicated story, but the AI spend that Meta is doing is for internal use. And that's a very different model. It's a very different cost situation than it is for, say, a Microsoft, which is, building AI capabilities so that they can then sell AI services to their customers. Whereas Meta is doing it for themselves to help bring greater efficiency, greater profitability potentially to their advertising model in order to keep their Facebook users and other users attracted to the platform. And that's ultimately important. They need to keep them and they need to attract more. But it's a bit harder for folks to see how to justify that degree of spend that Meta is doing.
But you can justify it with Microsoft because I forget what the percentage of total revenue that Azure, that the cloud business represents for them, but it's well over 50%, obviously. And it continues to grow in ways that you just can't find that kind of growth in a revenue picture or for a stock. You can't replicate it.
Yeah, and we're seeing that in this space. I wrote a commentary a few weeks ago about this in the middle, of what's today, the 30th. So 3 weeks ago, the 7th after so-called Liberation Day and that volatility. And the point of that was to say, look, there is real growth here in AI. Artificial intelligence is just beginning to change the way companies do business, the way they run their operations, the way software is written. We're going to see a lot of services that come out of artificial intelligence that we've never seen before. And the companies like Microsoft, even Apple, although they're admittedly late to the game in using AI, and others, they are selling these services. You look into the software sector, like a ServiceNow, for example, right, using AI to change what they're doing for their customers, and it's bringing them more business and it's bringing them greater profitability. So, the value of the growth from AI and its development is something that the long-term investor, should really pay attention to. And, even in the midst of all of this chaos, which is real, by the way, so the title of today's show is an important call out to that. But there's still long-term growth happening in this country. And right now, it is centered on artificial intelligence.
I work 9 to 5 at a firm that is based in AI, and I can just tell you that I've already seen my own productivity over the last 2 years increase dramatically in just the amount of content I'm able to create for us as a one-man band using AI. But what's interesting to me as well is the destruction that AI brings about. And that word has a negative connotation, but I think it was Satya Nadella who just yesterday said that 30% of all code at Microsoft is now being written by AI. I have a nephew, by the way, who works for Microsoft in their AI division. So I hope he's not in jeopardy. But that should be a sound an alarm for a lot of people, or should it not?
Oh, yeah, it actually should. There are certainly going to be some people like yourself who are made more productive by tools that are enabled by AI. But there will be others whose jobs will be displaced. And, this kind of disruption to an economy is not instantaneous. It will play out over years. The end effect will be a positive one in aggregate, but that's like saying NAFTA was a positive in aggregate. That's like saying robotics is a positive for the aggregate economy. It doesn't mean some people don't lose their jobs. And for those people, it's a very tough recovery because they need to get retrained then in something else. So yeah, there's disruption coming for sure.
Okay, we're going to continue that discussion. I want everyone to know, too, you can ask questions of Dr. Feeney and our other guest who's now able to join us. We had some technical issues at the beginning, but Will Rhind is the founder and CEO of GraniteShares. And Will, it's good to have you here. We slugged this episode, Profit from Disruption, because we wanted to get an idea in the world that we are experiencing, as we've just been talking with Dr. Feeney. How do you, as an investor, figure out where we're going next when for the last 40 years we had a very stable understanding of the pathway forward? So, Will Rhind, it's good to have you here, and thank you for joining us. Let me ask you, you said not too long ago that the motivation to found your company was because investing had no longer been exciting. Have you had enough excitement over the last 3 months?
I think everyone's had enough excitement since the beginning of this year, Adam. So definitely been a challenging time for everybody. But I think the question is, whenever there's adversity, It's always about, well, are there strategies, are there techniques that we can use that actually can help us in times where we have elevated volatility, and so that we don't have to run for the hills and go to cash.
And when you talk about run for the hills and go to cash, not too long ago, you were interviewed on Investing News, I believe, and you talked about the drive to gold. And the phrase you used, it seems very basic, but it is very honest. When people fear the return of their capital, they look for safe havens in which to park it. And the safe haven was not the U.S. Treasury, it would appear. It was gold. Is that going to continue, do you think?
I think at the moment, all the signs are pointing to the fact that it's still a very positive environment for gold. And when you consider the reasons why, I think number one, the thing that motivates investors more than anything else is what I call the fear premium. So this is, as you rightly pointed out, Adam, this is the fear of your capital being returned rather than necessarily a return on your capital. And the fear premium motivates investors like nothing else. And of course, when you have this kind of environment with elevated volatility, where you have a trade war going on, uncertainty around which direction the market is going to go, investors are looking for something which is not traditional stocks or bonds. And gold is typically one of those assets, if not the asset that people go to in times of distress. So that's the number one thing. The number two thing for me is if you look at the chart of global M2, so this is the money supply, in other words, the issuance of paper money against the value of gold, you can see it tracks very closely. So sometimes I like to think of it as not necessarily that the gold price is going up. It's more that the value of paper money is going down when measured in gold because of all the money printing, the debt explosion, et cetera, with governments across the world. So I think these are kind of the two things that are really contributing to the rise in gold at the moment.
Well, Dr. Feeney, let me speak to you about the fear premium. Because in the talking points that you shared with us, you talk about the S&P 500 may be in for a rough ride, but that doesn't mean all stocks are going to suffer. And my favorite, McDonald's, is one of the stocks you would point to. And yet this is a global company. So how does the fear premium play into the future of an asset like McDonald's?
Yeah, the fear premium is that some stocks have become more risky than others. And in this environment, with this kind of a trade war, we're seeing input prices go up. Right? It's certainly the case that tariffs on final goods are going to create shortages. They're going to create higher prices, but more for investors, you want to look at what it's doing to the prices of parts of the intermediate goods that companies need to make the stuff they ultimately make and sell. And so one way to steer clear of those risks of what those what that rising cost is going to do to their profitability and therefore their earnings and therefore potentially their stock price is to look for companies that have less exposure to imported inputs. And McDonald's is a global company, there's no question. But when you look at how they operate in the locations where they have shops, they're sourcing locally, so they're less exposed, right, to the changing taxes on imports than other companies would be, and also just more resilient. Even in a recession, McDonald's tends to do just fine. People continue to go to McDonald's. In fact, other people that would have gone to a higher priced fast food place will trade down to a McDonald's. So it's a pretty resilient stock to hold through tough economic times.
You brought up, though, sourcing local, and I'm going to throw this question to both of you. I'll start with Dr. Feeney. There seems to be a backlash, though, even if they're sourcing local, and I heard this in a discussion on CNBC about Coca-Cola, that even though most Coca-Cola is manufactured in the region or the locale where it's then distributed, it's associated as an American brand. It's iconic, as is McDonald's. Is there, because of how people outside the United States may be viewing the United States right now, is there backlash that could impact a stock price? First, Dr. Feeney, and then you, Will.
Yeah, no, I think that's certainly a risk. I think that risk is not one to be completely ignored, but I think the benefits of their cost structure is probably, a better, more resilient feature of the company's profitability. We do certainly worry about boycotts. We worry about them for not just McDonald's, but also Disney and Coca-Cola And so you have to weigh the risks there. Disney, for example, we sold recently because not only do they have boycott risk abroad, but you've seen the significant drop in international travel to the United States. And so, we see Disney parks at risk from a drop in attendance.
Will?
No, I agree. I think, I hope that if we're talking about anti-American sentiment, around the world, I hope it hasn't elevated to the point where people are stopping drinking Coca-Colas or going to McDonald's. But that certainly could be a risk. I think I see it more manifesting in the drop in travel. Things like people not wanting to come or electing not to come to the US or selecting alternative venues for their vacations, etc. But I don't think it's quite at the level yet where we see, or I hope it's not the level where it's manifesting in actual, people boycotting brands in the way that that I suppose could happen.
And well, let me ask you, Will, from an ETF perspective, how does an investor, and I was sharing with Dr. Feeney that I'm a very conservative, passive investor. I've always done index funds. But how could somebody who wants to be more active use ETFs and in this environment protect themselves, because that's what your firm specializes in, from the volatility that just a year ago we didn't experience?
Well, there are a number of ways. I think one thing to mention, and through the lens of, what are people doing in ETF world, we talked about gold. That's kind of an obvious one. Another one which is interesting is I think overwhelmingly investors have been skewed to buy year to date. So in other words, people are buying the dip and they're continuing with this idea, I guess, a philosophy that, whatever turbulence we're seeing right now in the market, that there's an end, or it's self-inflicted, and like anything that's self-inflicted, that can be corrected. So we're seeing in terms of flows, not just from our company, but across the board in the industry, is certainly net positive real estate flows. And I think within that, there are some areas which stand out. So beyond gold, you see interest in perhaps more defensive areas of the market, such as utilities or consumer defense type investments. And then beyond that, it's, like I said, the buy the dip. But I think what we try and specialize in offering products such as our yield boost offering, which are options-based income products. And options are interesting because what the environment that these products like, first and foremost, they're income first and capital growth sort of secondary. But options thrive in a volatility-driven environment because the higher the volatility in the market, the more the implied volatility of the option, hence the premium. So these are strategies which we see are turning to in this time where they're starting to prioritize income as opposed to capital growth. And options-based income ETFs have been another area of big growth in the market.
Dr. Feeney, we were talking before the program about the risk premium. And, one thing that I think investors are, older investors, not younger investors, but older investors perhaps like me, like to hear is something you pointed out was it's okay to buy boring. And when Will was talking about some of the plays that people are making, I heard insurance. And one of the, I think, borings that you say it would be okay to take a look at is United Healthcare. Why are some of the borings a safe play for an investor?
Yeah, you'll find a lot of boring domestic-oriented companies like United Healthcare. Now, they had some issues recently because medical care is going up and they need to adjust premiums a little bit, and they will. Very well-run company. I'm sure they'll sort this out. But other boring companies, as Will mentioned, in utilities. Own a solid company like Duke Energy, or look beyond that for income, as Will was suggesting, was sitting in some ETFs. What we do at Advisors Capital is just invest in individual stocks. We don't use ETFs except in rare cases, and instead we'll pull together higher dividend payers. That's a way to be boring, to insulate yourself a little bit from the volatility of the underlying stock price by owning companies that pay 4, 5, 6, 7, 8% yield. Company like Kinder Morgan, pipelines for oil and gas. You don't rely so much on the price of oil. You're not as vulnerable to that commodity price of volatility. It's just about how much oil and gas is flowing through the pipes, because that's how they collect their fees. So it's boring, but it offers a very nice dividend yield. And that's a way to say, okay, I'm going to ignore the stock price volatility. I'm going to collect my dividends, and I'm going to, wait to live another day and own longer term growth oriented stocks for where you do need appreciation.
I want to play a soundbite from an interview I conducted with an analyst talking about what we should expect tomorrow when Amazon reports. And it was in the context of what's happening with tariffs and how that might impact a company like Amazon. So let me play the soundbite, and then when we come back, we're going to have a broader discussion about how the trade war is really impacting the mindset of investors. So here is the interview with Arun Sundaram.
Right now, Amazon has three growth pillars. It's e-commerce business, it's AWS, and it's their advertising business. Those are the three of the growth pillars of Amazon. But they're also investing in all sorts of other areas. Right now, there's a initiative called Project Kuiper, which they're launching satellites into the sky in order to bring broadband internet to underserved parts of the world. That can potentially help their e-commerce business. That can also help the AWS business. But right now, that's not, the revenue of that business is not really, in our outlook. Also, Amazon Pharmacy, we're not really, forecasting much growth there, but that could be a potential upside. Grocery is an area where Amazon has tried to invest in over the last, decade, but really has yet to make a splash in grocery. So these are all, I think, upside, to our estimates for Amazon.
Will, I'm going to start with you because for someone like me, that was exciting to me when he talked about Amazon getting into the satellite business, and they have been launching. And I, followed up with him a little bit later and talked about, well, they're going to compete with SpaceX. But when you look at Amazon with pharmacy and Amazon with grocery, how would somebody who might be excited about, oh, wow, Amazon isn't just going to be the delivery company anymore, play that? Is there a way to play that, but also protect myself with an ETF? Do I have to become an options expert because I don't possess the math skills to do that?
I think if you're talking specifically about Amazon and the prospects for Amazon tomorrow, maybe we have some of the breadcrumbs that have already been dropped by Google, by Meta, by Microsoft, tell us that it's going to be a good day for Amazon tomorrow. So we know that the deficit widened massively over the quarter, meant that potentially people are front loading trade, which is good for presumably Amazon's e-commerce business. So people are trying to rush to get ahead of the tariffs and buy whatever, whether it's inventory or end consumer products. The cloud businesses seem to be on fire across the street from the companies that are reported so far, which obviously bodes well for Amazon and the AWS business. So I think at this time, Amazon is trading at a very low PE multiple in a historical context because of the uncertainty around tariffs, whereas potentially people might view that as a buying opportunity for a company that still has a lot of growth left in it.
And Dr. Feeney, I know that you are, optimistic about Amazon. I hadn't even considered what the analyst I interviewed had pointed out about the growth potential for Amazon. Can you elaborate for us, what are some of the things that those of us who think of Amazon as either Amazon Prime or I get the overnight delivery real quick, that they're much more than that?
Yeah, I know that, those other efforts are still very small, and they're going to remain small for a while. But the biggest other is the Amazon Web Services, right? The cloud business and their delivery also of AI capabilities to their cloud customers. So like Microsoft, they've been spending heavily to develop those capabilities, and NVIDIA's shortage of chips is holding back some of their ability to really ramp up the cloud business. And that's why we think there's such a long runway of growth. The e-commerce business, even with a world of tariffs, and we will most likely see a very strong number out of the first quarter. Is right. We saw those imports surge. We saw folks trying to get ahead of tariffs, but it's really going to be their guidance for this quarter that's going to matter. We know from reports that they've cut their orders out of China, given the ridiculously high tariffs. They had to do that. Obviously, they're going to try to source from elsewhere. But those are the two exciting areas. Those others are nice options, to own, and it is certainly a cheap stock relative to the growth opportunity ahead. Just compare the PE on Amazon to that on the S&P 500 as a whole, and you're getting a whole lot more growth with Amazon.
So I want to take a step back and the bigger picture, because the trade war cannot be ignored. It's hard to understand where we are in this trade war because we have the White House issuing declarations about we're talking. We have the Chinese saying, no, we're not. You look at the ledgers and the ships are not coming to the ports on the West Coast. So what is that setting us up for? It was Torsten Slok over at Apollo Global Management, the economist, who said recession this summer. Will, I'll start with you on this one. If we're heading into a recession, are we going to see investors clamping down and being risk averse and maybe moving back into cash?
I think that is really the most important question. Now, when I said that people have been buying the dip, that's exactly what they've been doing this year as it pertains to ETF flows more broadly. But the question is, how long does that go on before people throw in the towel? And clearly, there's a very much a expiry date with all of this trade war, where people start to lose hope. I don't think by any means we're there yet, but I think some of these comments that you've seen, and maybe the one you referenced just then, is sort of alluding to that thought that maybe by summer, if there's no progress, or the progress is perceived as not being fast enough or not being substantial enough, that we start to see some of the real effects. We've already seen this sort of technical, contraction in GDP growth, but we I guess if there's no progress, or material progress from here, it could get worse, and that's where some of these reports are coming from.
Dr. Feeney, I'm a doom and gloomer at times, and I kind of ride the wave of public sentiment. What about you? Because you have a perspective, as does Will, from above it would appear. What are you seeing?
It all depends, right, on how these tariffs play out. If tariffs come in as they stand now, plus we get those tariffs after the 90-day reprieve, that would severely compromise the productivity of the U.S. economy. Imagine lumber, steel, aluminum, parts. Imagine what that does to the construction industry. Imagine what shortage of computers does to every service company who rely on computers to do their businesses, right? It's the intermediate inputs that are the problem, and that's almost half of all imports. So it's a significant hit to the economy. So the question of whether there's going to be a recession depends on what we're going to see. And I'm not a political scientist, right? I don't know how this administration is going to try to navigate these negotiations. Typically, trade deals take not weeks, but years. So, but then again, we put tariffs on in a matter of days. So the timelines from history may not at all be relevant, right? So, we'll have to see, but it can be very damaging to an economy. It's a self-imposed tax. Like, let's charge ourselves more for all these goods. Why? I don't know. But it would be really, really damaging to a lot of businesses to have to pay such prices. Also, small businesses, which we don't think about a lot in the investing world because they're private companies, they're not traded. But small businesses that, created businesses because they could get things cheaply made out of China, they will go belly up, right? They won't be able to survive with the kind of tariffs that we're seeing now. And, they shut down, they fire their accountants, right? They fire their workers. That's potentially a big hit to employment. So, that's kind of a worst case scenario. This administration seems to be signaling, particularly in recent days, that they are moving ahead towards deals. There's something, potentially with Europe. There's back channel, who knows, talks with China. There's work with India. Could be that this was a big threat that ultimately leads to much more modest tariffs. But even modest tariffs can be very damaging. Even if we're talking about 10%, 20%, that's a significant tax to put on yourself. So, it's not going to be easy to get through this. This is a major change. This is something broken for the U.S. economy. And it's going to be hard to imagine all of this simply evaporating when we go back to normal. So this doesn't seem likely.
Will, can Humpty Dumpty be put back together again now that we've knocked Humpty off the wall?
I think the good thing is that people tend to have quite short-term memory spans. So I'm an optimist at heart, and I do think that if this was to kind of evaporate, quite quickly, we would be, back to normal in fairly short order. So I do think that if something is self-inflicted, clearly it can be resolved in the same way. And yes, there will be probably some hurt feelings kind of along the way from trade partners, etc. Certainly, the Chinese, I'm sure, won't be delighted about how this has played out. But I do think that things could be resolved. We could get back to normal quite quickly, and I think you saw that a little bit in terms of the market reaction. A couple of weeks ago when the bond market started to really seem stressed, which caused the 90-day pause in tariffs. So I think it could come back quite quickly.
What are you seeing, Will, in the flows of in and out of ETFs? What is that telling you that an average investor could possibly use to help them make decisions?
I mean, it's sort of similar to what we talked about already, which is the flows are perhaps going into predictable places, but they are going into the market. So in other words, this rhetoric of people are running for the hills doesn't hold firm with the ETF market, to date, as we see it. And people are definitely buying. They're using that opportunity to come in and buy, whether it's stocks like Amazon, whether it's major market indices like the S&P or the NASDAQ, at prices significantly lower than they were at the beginning of the year. And so I think that holds for so long as people, give the administration the benefit of the doubt. But make no mistake, this has been a huge shock and people did not see this coming and are trying to, work out, how long this is going to go on and what the end game is.
And yet, Dr. Feeney, you point out that perhaps there is value because of the dip that they saw in NVIDIA and Broadcom and Palo Alto Networks. I mean, is this an opportunity for people who are willing to maybe come in today and hold for a long term, or should they be reevaluating every 3, 6, 9, 12 months?
Yeah, NVIDIA, Broadcom, Microsoft, these companies all represent the part of the economy that's likely to do fine despite what's going on with the tariff side of things. Also, at least we're in a good situation heading into this, right? Unemployment is low. Productivity has been pretty solid. Personal incomes, even aside from inflation and taxes, has been growing, right? The consumer has remained strong. The weakness we're seeing in business investment is the question. And as Will said, if things do settle, right, the uncertainty that's held back business investment could improve. So for investors that have a sufficiently long-term view, and I'm not going to define sufficiently, these stocks have come in. And if you look at NVIDIA, its multiples come down considerably, but its growth prospects haven't. And if you don't own NVIDIA, if you don't have a reasonable position, it is a good opportunity. Broadcom as well, one of the most resilient companies out there, far more diversified, right? It's in software, it's in security, it's in hardware networks, network products, it's in GPUs, or they call it TPUs, for other companies like Google. And so these are solid companies to own for the longer term, and this is a buying opportunity.
I just have to ask you, Dr. Feeney, you're also a fan of Philip Morris. What is it about Philip Morris that has you giving it a thumbs up?
Well, inelastic demand, right? I mean, they can handle higher costs. They can pass them on to their consumers, and they pay an awfully nice dividend. And of course, they are getting into what is it called? Heat, not burn. Mm-hmm. Tobacco products, right, which are arguably safer than standard burn cigarettes, etc. But it's that dividend yield. It's very solid. They have terrific cash flow, and they have a wonderfully inelastic customer base.
And so, Will, let me start to wrap up. What is it that makes you most optimistic? And what is it you think that average investors like me are optimistic about? There's plenty of pessimism out there.
There's plenty of pessimism. I think what makes me optimistic is that the key investment trends that we saw the last couple of years, but coming into this year as well, namely AI, artificial intelligence, cryptocurrencies, probably more broadly, and then to a lesser extent, the electrification, through autonomous vehicles, et cetera, is just shows no sign of slowing down. If anything, it's accelerating, as we've seen from the comments from Microsoft, from Google, from Meta, etc. So, we're talking about, as Dr. Feeney said, companies like Nvidia, which are at sort of sell-off prices given what's happened. And this is a company that, there's probably still a reasonably good probability this company goes to 4 trillion market cap this year, despite all of the craziness out there. But this is a company that the multiple has come down, but the growth rate has absolutely not, and is a company that is, has a product that is in demand and has been fought over by both Washington and Beijing. So, it just tells you the strategic importance of AI and the players within it. And within these players, there is no one player more important than NVIDIA.
Dr. Feeney, what is it that you're optimistic about, and do you think it's shared by average investors?
It's hard to tell what the average investor is up to, except by trying to see what the market is doing. So clearly there's some out there who are quite concerned about the short-term volatility. I would say the source of my optimism comes really from the ongoing innovation that we are seeing happen in this country. And it really is, at this point, grounded in AI and its adoption. And we have yet to see all the different applications of that. So for the longer term investor, I think you can find a place to put some of your resources into that longer term growth opportunity, and then to buffer yourself from the near term volatility, which could last quite a while, right? We just don't know how long this is going to take to play out. One other stock I wanted to mention, Adam, in addition to McDonald's, is TJ Maxx.
Sure.
Because folks love to bargain hunt. And if the economy gets tough, my optimism in the resilience of the consumer is that they will seek out bargains. And so there are stocks out there that one can own that do well during recessions. People tend to shop down instead of Nordstrom, TJ Maxx. And so that's an opportunity for investors to ride out the near-term turmoil and still to build some real potential growth into their portfolios along the way.
And now the question that puts both of you on the spot. Warren Buffett, Berkshire Hathaway, this coming weekend. He's 94 years old. Will, if you were on an airplane sitting next to Warren Buffett, what's the one question you would ask him?
That was a great question. I think probably how he manages to stay so humble after all these years, and all of the wealth that he's amassed, the knowledge that he's given out, how he sort of maintains the same sort of humble characteristics, and seems like he's done very consistently throughout his whole life. So probably more of a personal question than a business question.
Dr. Feeney, if you were on that airplane sitting next to Warren Buffett, what would you ask him?
How does he manage to stay so healthy and drink all that Coca-Cola?
Well, I hope that I suffer that situation, because I love Coke, and I'm really hopeful that McDonald's, I can't remember what the French fries when they were made in beef tallow, what they tasted like, but I want to experience that. I appreciate both of you joining us on Talkenomics Live. Will Rhind, the founder and CEO at GraniteShares, Dr. JoAnne Feeney, portfolio manager. Thank you so much for joining us, and a portfolio manager at Advisors Capital, the two of you. It's been a pleasure having you on Talkenomics Live, and we will see you next Wednesday here on the stream.